Testing. 1, 2, 3. All right. Good morning. How is everybody this morning? Nice to have you all here. Glad to see a lot of guys sitting here waiting for the market to open with me. And we got a group. I'm always happy to see when I first turn on the system that a bunch of guys in here waiting for the show to start, waiting for the market to open. So it's always good to have you guys here. Always glad to have you and be here first thing in the morning, ready for watching the ponies run. I got a good class for you today. Got some stuff that maybe we can learn a little bit more about. And we're going to go over and look at the trade miner. Remember, Monday is trade miner day. So we're going to do trade miner. And we're going to do the futures version this time. We do need to swing back over and take a look at our stocks, the stocks that we put on last week. Jim Cramer's stocks. Remember Jim Cramer sent me an email and said, hey, Lan, you should be looking at all these stocks. And so we went through last week and we pulled up all the stocks Jim Cramer said we should look at. And we even put some options on some of them and we read them. And it's always fun to go see what old Jim Cramer's up to, especially with this Pet News magazine that's coming up. Oh, my goodness. You guys are going to love the new Pet News magazine. Pet News magazine, guys. You got to get it. You got to get it. If you don't have it, you got to get it. All right. Drive 1, drive 2, drive 3. Where are we at? Drive 1, drive 2, drive 3. Drive 1, drive 2, drive 3. What does that mean? Well, pre-market session. I'm not sure if it means anything other than the fact that that's what it did. We got our little drive. We got our counter trend here. We got our next drive. We got another little counter trend in here. These are those little flag formations. So that's what those are. And then the market continues to fall out the bottom of those flag formations in the downtrend. Same thing over here. Same thing over here. So we got these little flag formations that come in here. These are little pennants is what we call them. Okay. Pennants, flags. Okay. So that's what those are. Now what we got to see is if the market's going to rebound and come back up 50%, last major move. That's usually what happens. But you got to take into consideration the opening bell. So the opening bell's coming in here. We're not exactly sure what's going to happen here. As this market comes in, we would expect it to come back up into this region here. This is the 50% ruler. Let's put on the Fibonacci ruler. Give us a little bit wider berth in there. There we go. Fibonacci ruler, we'd expect these markets to pop back up into this region here. Possibly back up into the 61.8 and then flop. Is that what we usually see in the mornings? And you're like, yeah, Lan, if it does that, why don't we take a trade off of that? Let's go full screen on the S&P 500. Look at this thing rallied up out of here. First thing in the morning, drive 1, drive 2, drive 3. So we got our little counter trends in here, little counter trends in here. So the market actually in the pre-market session did pretty good, didn't it? Drive 1, drive 2, drive 3. Kind of not as pretty, but that was early morning stuff. So we got our little 3-drive pattern down. We got a little 3-drive pattern up. We got a little 3-drive pattern down. Now what's it going to do? So we're going to look for this thing to take off here in a second. What time is it? 26 seconds till the bell rings. We got 26 seconds. How do you know 26 seconds, Lan? Well, it's got a countdown timer right there. Can you see my countdown timer right up there? 16, 15, 14, 13. Counting down till the opening bell. How do I know it's the opening bell? I'm looking at my computer clock. It says 7:29, and for me it's 7:30, the opening bell. 5 seconds, 4 seconds. Look at it get excited. 2, 1. There it is. There's the opening bell. Opening bell. I thought we traded 23-hour markets over here in the futures market. Well, we do. This is a stock market opening bell, and it reflects on what's going on in the stock market over here since these are stock indexes. And we can trade the stocks indexes out of Chicago. All right, so this thing popped all the way back up to 78.6. Look at that. Woo, went right up and touched it like a train on rails. Sitting here bouncing around in that Fibonacci sweet spot right now. What's it going to do? What's it going to do? When it gets way up there like that, we ought to buy a put option because we expect it to flush back down again, right? But it might not, because why? Why would it might not? Well, we had such a big run here. This would be a drive 1. This would be a drive 2, and we look for drive 3, right? You got to realize that these are 1-minute charts. This is myopically looking at the chart. And so these are longer term time frames as well. You got people trading 5-minute charts, 10-minute chart, 15-minute charts, all different kinds of time frame charts. Well, if that's the case, Lan, how come you're only trading a 1-minute chart? Well, I'm trading a 1-minute chart because on my other 6 monitors, I have other time frames. You all know I don't have 6 monitors. I got 3 monitors. This is my travel computer. And so I've got 3 other monitors, and generally that's what you would look at is other different time frames on different monitors of different markets. But because we don't have that capability, oh my gosh, look at that NASDAQ. Just took right off like a rocket ship out of that bottom of that thing. Pulled back. Holy cow. But look at the Dow flushing lower. Old cousin Russell, he can't decide what he wants to do. It's always a little bit different. Always riding his tricycle, something else. Different than everybody else. There's one up for every down. One up for every down. Lane, you always say that, one up for every down. Well, we're going to talk about that today. I'm going to show you a neat new tool. Those of you who looked at the little marquee out on the front when you first came in, it said RAF. What the heck is a RAF? RAF indicator. We're going to talk about the RAF. Look at this thing go. S&P is taking off to the moon. Going to come up here and test the previous pre-market high. Trying to break it right there. What's the pre-market high over here? Lan, why aren't you trading? Why aren't you making all kinds of money? Why aren't you rich, rich, rich beyond your wildest dreams already? Look how easy it would be just to get in there and be rich, rich, rich. Okay. That's why I'm here. Show you how easy it is so you can go do it. You think it's easy? Go do it. Look how easy it is. So easy. It might look easy in hindsight. It's not easy on the fly. Not so easy. We got to do a little bit of swag in here. Got to do a little swag, a little scientific, wild-ass guess at what we think is going to happen before we go jumping in. Previous high. Usually it'll flush. Go back down the other way. Well, if it's going to flush, why don't you take it to the flush side? Okay, well, maybe we will do that. Maybe on this S&P, we could take it to the reversal side. You think it might turn and flush back down out of here? It might very well do, but it might not do it immediately. So we're going to wait and see. Sometimes it does, doesn't it? Sometimes it just turns and falls like a rock. It just goes boom, just like that. Right out of that rally, turns and goes boom. We see that a lot, don't we? And sometimes you're like, well, why didn't I take that short position when it came and break a new low? Well, because sometimes it doesn't do that. Sometimes it comes down, fakes you out, goes up, creates another little high, or even goes up and breaks a little high, and then it goes. So we have to kind of be careful. So we don't want to take a big, nasty risk, and the market's moving pretty hard right now. How big is that move, Lan? Well, from the low to where it's at right now, that's a $350 move on a single contract, or $750, actually. Let's just say $1,000 investment. $1,000 investment would have made $350. So that's a pretty good little move. Oh, look at this. The NASDAQ's flushing. All right. Where's our trading tools, Lan? Get in here. Fight, fight, fight. Win, win, win. Okay. The NASDAQ is flushing. The Dow is still on a rip high tear. The S&P looks like it's bouncing its head across that previous high, and it's not holding above it. If it goes up and holds above it, I'll remove my position for the short side. We're just going to look for it to turn flush like the NASDAQ did. But man, look at that Dow go. Ooh. That baby's on fire. How much? How much, Lan? How much? That's gone 300, and there's your $350 on that one. $350, $1,000 investment. Okay, NASDAQ's flushing. Flushing back down, just like we said. Just like we thought it might. So there's the previous high on that one. Went up, broke it. Ooh, went all the way up to 1850. Ooh, there's that 38. Okay. What's our Dow going to do? It's going to do the same thing? Oh, look at Cousin Russell's deciding he wants to go up a little bit. Remember, this is that morning session where the markets are feeling all of those overnight, over the weekend orders. People who put in over the weekend orders. So they got to fill all those orders from over the weekend, longs and shorts, and match them up. That's why the market goes crazy on the opening bell.
It's going to hold above there. Let's see S&P go up there and hold above it. It's going to go up and try. It's not holding above it. Okay, we're going to learn about the RAF today. We're going to learn about trends. We're going to learn about one up for every down. I made the comment, trade a lot, trade small. I need to readdress that. Some of you got confused on why I would say that. When we're trading in the futures market and we're day trading, we don't want to trade a lot. Be very judicious about your trades. Be very careful. You have 7 hours to make 3 trades. All right. So your daily goal is to make 3 trades. See if you can't make money in 3 trades. If you can't make money in 3 trades, you got to stop and come back tomorrow, or at least wait and come back at 10 o'clock, 9 o'clock, 10 o'clock. Those top of the hour moves are important to us. If you try and trade this first hour, 7:30 to 8:30, and you take 1 or 2 or maybe 3 trades, you get your hiney handed to you, or you're in green. You got to get up, walk away, go make some eggs, do something. Then you can come back at 9 o'clock and watch and see if there's not going to be a trend at the 9 o'clock hour. And then if not, you're going to come back at the 10 o'clock hour. All right. But you're not going to take big risks. If this thing doesn't just immediately go in your favor once you get in, just get right back out again. You can always get back in, but if it just goes and then pops and fills all the orders and then goes and rallies back up, there's no reason to worry about that thing going to the moon. It might still just go to the moon. So we want it to fill our order and just drop. And if it doesn't, it's not weak. It's too strong, too many buyers. So just get out if it doesn't drop. See, just like that NASDAQ, it just flushed. If we would have got in right there, it would have just flushed down. That's what you want. You want it to just kind of flush down. If it doesn't flush down, just get out. Don't take a big loss. Well, but Len, I want to build a pyramid. Well, don't be building pyramids in the first 2 minutes of the opening bell. That's it's not a good strategy. Don't do that. You can start building your pyramids when you get into a slow, lazy, lackadaisical market. And it's into an extreme on the other side. Flush, you little toilet. Flush. Okay, down flushes the Russell. Russell's dropping. We could put a short position on the Russell right there too. See if it wants to flush for us. All right, so you get your 3 shots at the market first thing in the morning if you want to play this opening bell. It's a dangerous time to be trading because the market is very unpredictable and it goes all over the place. So if you want to play this at all, you get 3 shots at it. Try it. All right, try. Give yourself some rules so you don't go wild man on me. You get 3 shots at the market first thing in the morning in the first hour. From 7:30 to 8:30, you get 3 shots. That's it. 3 small positions that you can take on these wild and crazy markets. And if you can't make any money, you lose money. You got to get up, go make some eggs, make you some breakfast, walk around the house, go for a little walk around outside, calm down, cool off, come back at 9 o'clock. And watch the market and see if it doesn't want to trend at 9 o'clock. But don't get all too worried about, oh, look what the Russell's doing. That's not good. S&P could follow. Dow's following, going up. We got our position in here. It's stabbing those little yellow dots, and it's not flushing. So that's not good for us. We need to see it flush a little. This is all bullish on all the other 3 markets are bullish, and we're bearish. We're short. So that's not good. We need to see the thing move. Doesn't, we're just going to get out. Come on, you little rotten bugger. It's not flushing like I want it to. All the other markets are rallying. S&P is going to get ready to go up too. We'll get out right now. Okay. We can always get back in if it wants to flush again. Everything else is going up though.
It's just being stupid. Now it wants to come back down again. Look at the Dow taking off, going to the moon, breaking above that previous high through that little triangle formation right here. So as I was saying, you get 3 shots in the morning bell. You can't make money in the first 3 shots. You got to walk away from this thing because this is the nastiest time of day to be trading. Lots of opportunities when the markets are running hard, but they're also very hard to get into because lots of topping tails, lots of bottoming tails. Those are bad. Those are what stops you out. So then you walk away, come back at 9 o'clock. 9 o'clock, the market calmed down a little bit, starts to show a trend. You often have lots of people step in at the tops of the hour. So you trade from 9 o'clock and see if there's not anything going to happen in the first 20 minutes. If nothing happens in the first 20 minutes at 9 o'clock, you walk away again. You get 1 or 2 shots at the market, very small ones at the 1 or 2 o'clock. You walk away. You come back at 10 o'clock, and then you get a 10 o'clock. And that's my time. Make the adjustments for your own time where you're at in your own time. It's 7:30 my time, and then 8. Then I'll go back at 9, and then come back at 10. Those top of the hour moves are important to us. The markets have a tendency to move at the top of the hour. Why are you trading the S&P today, Lan? Well, it was the one that was lagging. I like to trade the laggers. Usually the other markets will tell you which direction the market's going to go, and then whichever one's the slowest to go that direction is the one I generally like to jump on. And it usually goes in the same direction, just a little bit slower. Today that was the S&P, but the S&P's being stupid now. It's just dying on me. Look at the NASDAQ. It had that massive run up and then it just died. Lots of highs, lots of lows, lots of topping, lots of bottoming tails. Nothing. But we all know it'll break out at one of these points and it'll go. And then you'll look back at hindsight and you'll say, why didn't you just get in right there? It was so easy to see. All right. Trying to take another long position on the S&P. But this is not good where the NASDAQ has just died on us. I don't know if we're going to get anything out of the S&P. You should have been trading the Dow, Lan. Should have been trading the Russell. I know. Hindsight's 2020. Ugh. Missed it. Oh, damn it. Come on. Just fall a little bit for me. I didn't have my profit-taking OCO in there. There we go. Take it, touch it. One more. Oh, you dog. Bring it down in there. One way or the other. There we go. All right. We got ourselves back to green. You know me. I like to get back to green. If I get down first thing, I like to get myself back to green. Back to break even, get my money back, and then I can take a deep breath and try again. Wait for another setup. Look at it falling out the bottom of the NASDAQ now. Look at the Dow still running. Look at the Russell. Still rallying. We got to take a couple of trades. We get taken out on that one. But look at this little shelf right there. Beautiful little shelf. We cut that one back down for enough to get us back to green. Boy, look at the NASDAQ now. It's coming down to the blue line, isn't it? Going to come down, touch that blue line. You think the S&P is going to come down to the blue line? What's going to happen? Come on, markets. All right. Touch the blue line. Is this one going to come down to the blue line? Look at that big old Russell run. Holy cow. Lan, why don't you just trade the Russell? Just trade the Russell. Close everything else out. Just go trade the Russell. It's always the one that trends. Well, I thought we might put an option on our S&P when it hit that previous peak up there. That was my initial intent. I was going to put an option on there for a short position, but then I took a contract instead. That's a beautiful little shelf right there. Little area of support across the bottom, right along that line. There it is. Look at that. The NASDAQ's coming right down to the blue line. Now the question is it going to break through it and hold below it? Can you lower? Boy, that NASDAQ's flushing. So is that S&P back to the blue line too. Do you think the Dow's going to go? If you think the Dow's going to flush, we could take another short position on the Dow. And that wasn't the Dow. Doggone it. I hate it when I do that. All right, we're taking a single short on the Dow. See if it won't follow these other. S&P fell, NASDAQ fell. Let's see if the Dow will fall. Trade the lagger. We got the Russell. We could take it on a lagger too. It's getting up there. Come on, ding dong Dow. I'm going to wait for the Dow to pull back. Try again. I don't think it's going to flush like a toilet. It might, and I just got out, but I just took that as it broke those yellow dots. Sometimes it comes down, breaks them, then turns around, stops you out, and then flushes. So I'm going to see if it's not going to do that this time. I may be wrong, and I'll feel bad because this thing just goes straight down and make topping tails all the way down. But I want to see if it's not going to pull back against me. It does that a lot. Everybody who's getting in short, then the market comes back up, stops all the stops out, and then turns and falls. We're going to catch it on as it comes up back to stop all the stops out. Let's see if it'll do that for us today. Look at that Russell. Just keeps going. We're getting a little pullback on the S&P, a little pullback on the NASDAQ. Here comes the pullback that I mentioned on the Dow. Could be a break just to go high. This could go up. Get in, Land. Take the long. All the other markets are going up. That one wants to go up too. Let's wait and see if it really wants to. All the other markets flushed all the way back down to the blue line. I was going to take a short position right there when it spiked those yellow dots. I was going to get short. Come on, take it. Take it. It's like fishing. Throw your bait in there. See if the fish will take it. There, it took it. Now what are you going to do if you're wrong? What if it just keeps going straight up, Lan? Well, I'm going to get back out. I'm waiting for it to make a little shelf right here. I want to see it fall out the bottom and come back down to the blue line. That Russell, though. Wow. Did you guys get in? Anybody get into the Russell? Anybody riding that thing up? Talk to me, Bruce. Talk to me, Goose. Bruce Goose. Oh, here we go. Look at the little shelf being built right here on the NASDAQ. Another little shelf. Is this a shelf right here? Is this going to flush out the bottom of there? Anybody else in any of these markets? Come on, speak to me. Speak to me. How about here? Look at this. Are we looking for this to flush down here? All right. What's the RAF? What's the RAF? Let's use it right now. The RAF is a trend indicator. All right. So when you draw your trend, I always say one up for every down, right? An up goes like this. Well, there's also an upside of that. See that? It's also a channel. So you have not only support on a channel. I generally just draw the one side of it. I don't generally draw the other side like that. But what you're doing is you're watching that market go up through a channel, and it generally goes up and hits the top of the channel, hits the bottom of the channel, and bounces back and forth between the two. Sometimes it's a little less aggressive than this one. Sometimes you get a channel that looks like this, right? Not quite so aggressive. And those are a little harder to trade. They're a little harder to trade because the market's just kind of going sideways. And what happens, it keeps going up and it comes down and stops you out. You get in and goes up, it comes down, stops you out, goes up, and it goes through a channel like that, right? Those are a little bit harder to trade, those channels. So this is a channel. Well, this is also a channel like this. So these are actually channels coming in here. I'm disappointed in what's happening over here on the Dow. You rotten little bugger. We thought it might come out of the bottom of that thing. How much you going to risk, Lan? How much you going to let it take away from you before you get out? Not much more than what it already has. If it doesn't flush, I just want to get out. Put a stop in. Well, that's where everybody's going to put their stops in. They're all going to put their stops if it breaks a new high. So it's going to draw it up there to touch that, and then it'll turn, break it, and then it'll flush. So you're going to have to sit through a little bit of take a little chance here that this thing's going to go up and break that high and then flush. Because there's a bunch of stops sitting right up there. And the market makers know if they go up there and fill those, they get paid a lot of money. So it's going to draw that up there. The question is it going to stay up there once it gets up there? Because a lot of guys will put buy orders to buy above there, and that'll draw the market up. So we're taking a dangerous little situation right now because the market wants to go up and fill all those orders that are sitting above there. A lot of them are buy orders, so it could force the market higher. A lot of them are stop orders where we got in short like this. We're not the only ones sitting here like this. A lot of orders sitting right there at that level. That market wants to go up and fill them because if it fills them, it gets paid. You got to think of the market as a big machine. Its job is to fill orders. And if you put an order out there, it doesn't know whether you make money or lose money when it fills your order. All it knows is that it got paid. And that's how it makes money. Fills your order. So if you put an order out there, it's like, oh, he wants me to fill that. And I'll get paid if I do. And it goes to where the most orders are sitting. And so you got to kind of learn where most orders are sitting. Well, they're going to all be sitting at where people put their stops at. Their stops and limits. All right. So those show up in the books. As soon as you put a stop on there, they can see it. They have to be able to see it because they have to be able to know where the market, where to fill your order. All right. Those are the guys that don't show up in the books. They don't show up here in the, well, they do up here. Well, their orders don't show up here, just their trend. All right. So it pulled back a little bit. Didn't quite break that previous high. That's called a double top up in there. It's coming back down. But it's being stupid. Come on. If it doesn't keep falling, we're just going to get out. All right, I'm going to put a trailing stop on this thing, just one bar back. I want flat tops, flat tops, flat tops. If I don't get flat tops, I want out. We're only in with one, so we're not taking a huge position risk here. I want to get as many flat tops as I can. Come on, flat tops. Flat tops. We like flat tops. What do you mean flat tops, Lan? Flat tops on the bars. Look, the bars, no topping tail. No topping tail. What are the other markets doing? I'm watching the other markets too. I want to see what they're doing. Keep an eye on what they're doing. They're all trying to fall out the bottom of these little shelves right here. See, I call them shelves. All right, the market comes down, creates little shelves. Area of support. Right there. See that little area of support? Previous high makes a little wedge formation. We want to see it fall out the bottom of that thing. Problem is, sometimes it falls out, fakes out, and goes up. So, well, so I'm going to put a stop in here, just right in here, just in case, just to break even, basically. Because if it pops up and breaks that previous high, I don't want to stay in. Why? Because it's not making lower lows and lower highs. If it makes a higher, if it breaks above there, it's not making lower highs. Piece of don't say it, Lan. You're going to have to confess your sin. Piece of crap market will, it's too weak to make lower highs. If it can't make lower highs, get out. Wait for a market. Wait for this setup. Wait for the trigger, and wait for a market that's continually making lower highs. That's called day trading. Or higher lows. If it's making higher lows, you can make money too. That's good. Market's going up, right? Making higher lows. See all these higher lows? Flat bottom, flat bottom, flat bottom, flat bottom, flat bottom, higher low, higher low, higher low. That's how you make money. But if a market's not making higher highs and lower highs, higher highs and higher lows, lower highs and lower lows, you got to wait for it to start doing that. Get out, come back at 9 o'clock. See if the market's not making higher highs and higher lows, lower highs and lower lows. If it is, get in. Ride it for as long as it makes those. Look at that. Look at that Russell. Man alive. Holy cow. That Russell's just making me angry. Angry trader. That's why I trail one price bar back. Because if it doesn't make it, see, just got out. What the heck, you stupid market? It's not making lower highs. Started making higher highs. So I don't want to be in there anymore. Well, isn't that a trigger to go long, Land? It is. You can get in right there if you want to. This is coming into this little longer term pattern. It's a longer term pattern. Let's get rid of these. So now what we're seeing is this little wedge pattern come up like this across the top right here. So it's becoming a wedge pattern on a longer term trend. If you go out and look at a 5-minute chart, that would look like a little pennant formation like we just saw here on the 1-minute chart, right? So our longer term trend pattern is trying to make this little wedge formation. Well, wedges to 5-minute traders, if it breaks out the bottom of that wedge, they'll take a short position here. So if it turns and comes, so it's going back into the wedge. So for them, they see it break this bottom here, they'll take a short position out the bottom. So that's why you'll see these things come down, fail, go back into the wedge, and then boom, fall out the bottom over here, because that's on a 5-minute chart. You're seeing a different pattern. But we're looking at intermarket relationships on all 1-minute charts from different charts. We're not looking at the 5-minute chart because that's over on my other chart, right? You guys have different monitors. So on your different monitor, you got a 5-minute chart or a 2-minute chart of your same markets. But I can't show you that because on YouTube, I can't project more than one screen at a time. But you guys are all smart and know that you got multiple monitors and multiple time frames because you've been coming to my class and we've talked about that in the past. Look at all these lower, higher, low. My gosh, this little rotten bugger over here on this Russell's just making me angry. But when it flushes, Land, is it going to just flush? Is it just going to go down, just woo, all the way back down? Well, it could, and you could take that chance if you want. But usually what it does is do one of these. So you can wait for it to go, prove it wants to, come back, catch it on the rebound, and then watch it go. That's what we did up here on the Dow. This thing came down, it broke, came back up. We got in right here when it touched this area right here. And then we rode it back down into here. And then we got out here. Now we're going to see if it's going to break out the bottom of this thing. Do you want to take another short position here, Lan? Not really. I'd rather come down here and trade this Russell. But what I need to do is I need to teach you about the RAF. So the RAF helps us identify one up for every down, helps us actually identify the trend. So let's use the RAF here. Here's the RAF. It's right here on the Raff Regression Channel. I'm going to come up to the preferences. We're going to click on the RAF, and I'm going to draw it from the low to the high. All right. From the low point to the high point. And what it's going to do is it's going to then extend its trend out like that. See that? And over here, you got price bars. So you can increase how far it bends the trend and how shallow it breaks the trend. So when it breaks below that right there, helps you know it's breaking out of the RAF. And the RAF is important because it's got several settings for it. One is your normal calculation, and the other one is 2 standard deviations. And how many of you have ever seen this chart? Oh my goodness, Lan, you've shown us that before, haven't you? Yes, I have. How come that's doing that? I don't know how to make this thing work. I'm not very good at this YouTube stuff. Sorry, guys. So anyway, we all know that the market has a tendency to stay within the 2 standard deviations, right? 1 standard deviation, 2 standard deviations. During any span of time, 68.2% of the time, stock prices fall within a 1-to-1 standard deviation of the average. Stocks fall within a 2 standard deviation 95.4% of the time. So they stay inside that 2 standard deviation 90% of the time, 95% of the time. They stay inside the single standard deviation 68% of the time. So if we go back to the standard deviation normal, okay, there's your normal deviations right there. 68% of the time, the market will stay in the channel. Then when it leaves, it tells you it's breaking out of the channel. Then it has a 95% of chance of staying inside the next channel. So which is this one here. So it's got a 95% chance of staying in there. Now, if you get a market that's kind of going sideways, and it depends on how big you draw your channel too, right? I mean, channels can be pretty big. So I like to use the RAF on a 15-minute chart. So if we come down here and turn this into a 15-minute chart, and then we come in, let's turn on our Heiken Ashies, and then we're going to come in and we're going to draw the RAF over the 15-minute chart all the way to expiration. So we can say you generally want to go from highs to lows, but we have this much information. So this is telling me that the channel, the RAF channel, the standard deviation on this thing, it's going to stay inside that marker right there. How's that? So that's what it's telling us. Now you can adjust it, and it's going to move your channel. Okay, it's going to adjust your channel. You can go to a low like this. That's normal. Let's go 2 standard deviations. Now, it could stay in there, right? So you have to take that into consideration, that the RAF is going to only go based on where you're going to set it. So the more data you have, the more likely it is to give you better information. The less information, right? And of course, the bigger the more data you add, the bigger the trend is going to be. So the RAF is going to stay somewhere inside of there is what it's saying now. Okay, by expiration, should stay inside this box. That's what that's telling us. And if you come back here and you go even farther back, I mean, you're kind of getting a little crazy here, right? So take into consideration that we're not going to be in the market that long because we're going to do an option, but you're going to take all this data into consideration. Clear back here. Now, when we go to the end, now we got our great big huge move in here, right? You do that if you're going to take a longer period of time. Well, how far back do you go, Lan? Well, that's a good question because there's not a specific answer to tell you. I have a general rule of thumb. So what I like to do is I like to come in and I like to draw the RAF when I'm going to, and I like to use this for multiple times. I mean, you can do it for individual trends. I'm always telling you one up for every down, right? So you can go up, down. This is your little trends like this, right? So you start finding your trends. I'm going to show you something else that's really cool about trend lines as well. So these are your little projections for your channels. All right, you can get a little crazy with the RAF. But the idea is once a market starts to trend, you start to outline the trend with your RAF tool. And then when it breaks that, that's where you're going to anticipate, well, see, it's breaking out of the trend, this trend. If it would have broken, it uses this as support, it stays in the trend based on this mathematical model. That's what it is. It's a little mathematical model. It's geometry. And you don't have to do the math. It just does it for you. But you have to determine where you want to start the math from and where you want to end it. Usually we use trend highs and trend lows. All right. So we started at the high of a trend and we bring it to a low of a trend. Now, generally speaking, we want to pick 2 points. All right. You want to pick 2 points. And let me show you. I kind of jumped ahead in how this works, but you want to pick 2 points. Okay, so if we pick 2 points along a trend, we're going to pick the lowest point of a trend, and hindsight's going to help you, right? This is all hindsight and project out into the future where we think markets are going to go. So we've got a low point here, we got a low point here, we got a low point here, we got a low point here. We can see a natural trend line coming in here. So we can take this tool here. We can take our trend tool and we can watch this. We'll come in here and we start at this point and we drag it to that point. So the first 2 points of any trend, all right? And you can snap that, hit snap over here, and then it'll snap to those low points. That's generally a good idea when you're doing this. Okay, so we're going to snap that in. We're going to snap that onto the low. Okay, so now we have a line between the 2 lows. If we right-click on it, we can say extend the line. And then that line becomes your next trend line for the bottom side. You can then come in here and do the same thing. You can come in here and say from this high to this high. You're going to come in and you're going to go from this high to this high. Oh, you got to grab it and do it right. Oh, crap. I hate it when I do that. I hate it when I do that. Okay. Start over. Okay. Well, that's okay because I was starting a little early anyway. Okay. The RAF. I want to first teach you about the trend line. So the trend line, we're going to come in here and we're going to identify 2 points on a trend. All right. So hindsight's going to help you with this. You can identify there's a low, there's a low, there's a low, there's a low. What we want to do is we want to find 2 points on the trend. So we're going to take the trend line. We're going to hit a point here. We're going to hit a, let me draw it properly. From here to here. And if you want to snap it, turn on your snap so that that thing snaps to the low of the 2 points. So there and here. And then we're going to come and we're going to right click on it and say extend line. And that gives you the extension trend line. All right. You can do the same thing to the upside. So we can come in here and we can say, okay, I'm going to go from here to here. You can turn on the snap. You can turn the snap on and say save it so it always snaps. But I don't generally like the snap when I'm doing normal trading. This is when I'm doing analysis. Okay, so we draw between those 2 points, right? We right click on it. We say extend the trend line, and then that gives you your channel. Now this one broke out and went higher, so we come in and we draw the next leg. So we go from here up to here. Come on, draw your line, man. Up to there, we can see up to here. This would be high, it pulled back. Let's use this one. Snap that in there. So you're going to snap this in, and you're going to right click on it and say extend line. And it gives you that trend line going up. And then the market, and this one is giving it a broadening pattern. I hate broadening patterns. Why? Because the market has a tendency to bounce between these broadening patterns like this. And it's kind of hard to trade. Kind of hard to trade broadening patterns. Because you think it's going to break a new low, and it doesn't. It turns around and broadens up, and then breaks the high and only to come back down. Breaks the previous low, and then it's just kind of, that's why I don't like broadening patterns, because they're tough. You think the market's going to break and go higher, and it doesn't. That's when it breaks and turns and comes back down. So broadening patterns are tough to trade, but nonetheless, this is what you're going to get here. You're going to get these little patterns like this. Let's go back to a smaller time frame chart. Okay. So we can come in, we got 2 points. So we're going to take our tool, draw 2 points across the top like that. We're going to right click on it and say extend. So that becomes a area of resistance. We're going to do the same thing on the bottom. 1, and we're going to draw it down to here. You can snap it if you want. So it's exact, and then you hit extend and you get yourself your trend. All right. We're going to do the same thing here. Now this one, we can pretty obviously just draw it up there, but you could go from a peak to a valley. So peak to a valley, extend the line, you're going to get kind of a little pattern like that. Okay. So you get your channel. I think you get the idea here. So these areas become important to us throughout the day as they become areas of support and resistance along these channels. Now, there's an easier way. That's what the RAF is. All right. So we're going to come in and we're going to hit the RAF. This is the RAF tool right here, RAF regression line. And you're going to come in and you just draw it along the trend, just like that, from high to low, from high to low, high to low. And you can go longer trends like this. And this is where you come in and you see the market stays within, and I'm going to do it again. See, it stays within that cone of probability, the single level of distribution, right? The deviation, 1-to-1 deviation, or the 2 standard deviations. So now we're going to go see if I can go back to the charts again. All right. So we're going to go to the 2 standard deviations. So I'm going to click on the RAF. I'm going to come over to the preferences, and in the RAF, I have this normal and I have 2 standard deviations. So we go normal, which just kind of brackets the highs and lows automatically, or you can go to 2 standard deviations. You click that and it calculates 2 standard deviations. In this case, it was exactly the same. Let's see if we go 2 standard deviations. There we go. So see the 2 standard deviations on that uptrend. It's much wider. So what I like to do is this where I go back to that. We'll go back to the 15-minute chart where I was before. So we'll go back to the 15-minute chart. And depending on how long you want to take, so I have kind of a standard rule. If I'm going to kind of measure where the market's been, or where I think the market, where the expiration of my option is. If I'm going to do an option, option's going to expire in 31 bars. So I like to double it. So go back, 60 bars. So there's 30, 40, 50, 60 bars. So we'll go back 60 bars. We then grab that RAF tool and we include 60 points of data along that line. And if that's the case, that's what that RAF is telling us. Now we have to take into consideration this was a lot of nighttime session stuff. That's a whole day's time frame on a 15-minute chart. But that RAF is now telling us, and if we come into the preferences, we go to normal, or we can go to 2 standard deviations. 2 standard deviations is right here. So 2 standard deviations might be a little smaller than, depending on how much data you're taking and how big the market moves. So that's 2 standard deviations. So that's saying the market should stay inside this box to expiration. So now, what does that mean to us, Lan? Well, it helps us know if the market gets down into this region here, we can turn on our stochastics indicator. Why that's not on, I don't know. The stochastics indicator will probably come down into this oversold region. The market should come down. It should test this RAF zone down in here, and then it should turn at that point and go back up. Same thing on the upside. If it comes up here and tests this, stochastics indicator should be way up here in the overbought region, and the market should come back down. It should stay inside of here. However it stays, it should stay inside of there, right? So we should see it just wander around in here all the way to expiration. Now, it doesn't mean it can't get excited and it can't break out and go up and, do this kind of thing. It certainly can. Doesn't mean it can't come down here and do this. It certainly can. We're just trading the probabilities, right? So what are the probabilities? Once again, the probabilities, 68.2% of the chance it's going to break out of that RAF, and 95% that it's going to go outside the 2 standard deviations. So we on the RAF, we don't have 2 standard deviations. We only have, we do. We have normal, that's 1 standard deviation. Then we have 2 standard deviations. So there's your 2 standard deviations. So you got a pretty good high percentage, 90% chance that it's not going to go outside that RAF. So that's what that's all about. Okay. And the problem is that it depends on how much data you take into consideration. I mean, if you draw, is it going to be 90% there? You got three bar chance. Well, the more data you take into consideration, the bigger the movement of the RAF. That's why I say, well, it depends on how far I expect the market to go in the first place. If I expect it to go all the way to expiration, well, that's 27 bars and a 15-minute bar. So 30, 60, I'm going to go back to 60, and I'm going to find the highest, lowest point within the last 60, around 60, and that happens to be right there. So you can fudge it a little more, a little less, depending, but you want to kind of go to the low point or the high point of that area. Could we go here? Yeah, we could go back to here. We go back to this one, kind of adjust it a little bit. Okay. This says we're on a little bit more of an uptrend. This adds in a little bit more of a downtrend. That's okay. Make that adjustment. So now we're going to say, well, we think the market's going to stay inside that RAF. Now, how's that going to help me? Well, in your day trading, you can say, well, I'm going to only trade inside the RAF, or when when the market gets down into this region, that's where I'm going to start looking for longs, or when it gets up in this region, that's where I'm going to look for shorts. So that's what that's all about. But then we can come in with options, right? Because we can come into options and we can come in, I'm going to do a 0 DTE, and I can sell a call outside the RAF. Okay, so that's what I want. I want that to be outside the RAF. So 137.50, I can take that, sell that, and then I have, what do I have? I have basically a 68.2% chance that it's going to stay inside that RAF, but I can also come down to my option. I can raise my options up. Go to my options chain, and I can look at this, and the options chain has a probability on it. So in here, this is a call option, and I'm selling it, and it says I have a probability of being out of the money, 75.98%. So it says I have a 75% chance that market's going to make money for me. Okay, by expiration, it won't. I got a 75% chance that it's not going to be below there. If it does, I got 137.50 that I get to collect. And I could make it sooner. I mean, if the market continues to fall, if it just dumps right here, I'll make that money a lot faster. But if I have to wait for it to go all through there, and if it actually comes up and tests it, it just has to stay below that red line. It just has to hit that purple line before it hits that red line, and I get to keep all $137. Now that's a cash secured put, which means that I have a big margin, $12,494. We talked about that last week, right? Well, if you want to cash secure it with the money that's in your account, you can do that. Then you don't have to buy insurance. But if you don't have $12,494 to risk, and you're not risking all $12,494. Well, technically you are, because the market could go to the moon where you could lose $12,494. That's the point, right? Chance that happens pretty slim, but nonetheless, you're going to receive $122 if it stays below that red line, and you got a 75% chance it's going to do that. You've measured the RAF. You got a 90% chance it's going to stay inside, or 60% chance it's going to stay inside that 2 standard deviations. Or no, 2 standard deviations was higher, right? 95% chance it's going to stay inside that 2 standard deviations. So that's your odds. You're just kind of doing your swag, a scientific wild ass guess. This market's going to stay inside that RAF, below that red line, hit that purple line first, and you're going to make $122 if it does. So margin required to do that is $12,000. I don't want to put on $12,000, so I don't have $12,000. So then you just have to buy a call at the same time as an insurance policy, which in essence will stop your losses at that green line, right? So then you don't have to have $12,000 of margin. You just buy yourself some insurance policy, you buy a call, and now it'll start making money as much as the red one is losing money. So that's the idea, right? So, but you don't want to buy $82.50 worth of insurance. You could, if you did, you click that in there, you see your margin went all the way down to $194. So now you only have to max loss. They're going to margin you at your max loss. So the max amount of money you could lose is $194. So you say, well, I'm real willing to risk more than that. I got 75% chance it's not going to fall and it's not going to go up there. So I'm going to raise this up and buy less insurance. It's like when you go to the you go down to Farmers Insurance Company, you say, I need to buy some insurance for my car. Right? They say, well, how much of a deductible do you want? Well, I'm a good driver. I don't need don't you want 100% coverage. That's what they want you to buy, 100% coverage, right? But yeah, I don't want 100% coverage. I don't need that. I can buy a little bit of a deductible. So the more confidence you have in your tools and your swag and your scientific wild ass guess. Oh shit, I just said wild. Oh, I just said shit. Oh shit, I just said wild ass guess and I said shit. I'm gonna have to confess my sins. Damn it. All right, sorry. YouTube sinner. Here we go. So you're going to buy less insurance because you have a higher confidence in your analysis. You can buy less insurance. If you have less confidence in your analysis, you're going to want to buy more insurance, right? So here we can buy less insurance. So I'm going to raise that up. Now my insurance is $32 because I have to pay for that. I have to pay for that insurance. I have to pay $32.50, and that's going to come out of my $130. So if I'm going to receive $130, I have to subtract $32.50 out of it because that's my insurance policy. So, but that's going to make it so my margin is not $12,000. Okay. But I'm going to have a margin of $623 at this point. So now my max loss is $623. Oh, well, I don't want to have a maximum loss potential of $623. Okay, well, buy more insurance. Now you have a loss percentage of only $400 instead of $600. But now I have to pay $52 instead of $30. That's right. You're buying more insurance. If you're wrong, you lose less, but you pay more for that. But I'm going to be right. It's going to stay inside my RAF. I'm going to make money. It's never going to go up above that red line. Okay, then buy less insurance. You can buy almost no insurance. Go up there. There's $20 of insurance. But that means your margin requirement is going to go up to $859. Which means that's your max loss, which means the market would have to go up to that green line. What's the chances of the market going above that green line? If it goes above that green line, by the time it hits that purple line, that's the game you're playing. If it goes above that green line and hits that purple line, you're going to lose $859. What's the chances of it doing that? Well, pretty darn low. 94.95% tells you right there, probability of being out of the money. 94%. You got a 94% chance it's not going to do that. Okay. But that's not a 94% chance it's not going to go above your red line. You got a 74% chance it's going to go above your red line. So it's going to go into your loss zone. You got a 74% chance it's going to go into the loss zone. You got a 94% chance that it's going to hit your max loss of 859 up there. But I did my RAF and it's going to stay in my RAF land. Okay. Well, put your order on there and get rich, rich, rich beyond your wildest dreams now, because you know how it's going to work. You know how it works. That's how it works. Well, what about if I think it's going to continue up this RAF because it's bullish? Can I come and put one down here instead? Because I don't think it's going to fall. You absolutely can. Let's go put one on down there and see the comparison between those two. Let's go in here. We're going to delete these out of here and we'll put one on to the downside. We're going to sell a put down here and we're going to put it outside the RAF. By expiration, it's inside the RAF here, but outside the RAF here. Where do I want it land? Do I want it there or here? Well, depends. Be more conservative. You got your RAF in there. If you think it's going to be inside the RAF the whole time, it only has to be inside the RAF as long as it takes to be inside the RAF to hit that purple line, because this is a 0 DTE. It means it's going to expire today. It's just got to hit that purple line before it hits that red line. And you can put that red line closer because it's going to, the RAF is saying that the market's going up. So it's going to stay kind of relatively bullish. Even if it comes down and does this kind of a thing, it should go back up right before expiration. Who knows? Could come down and go like this, but that's why you buy the insurance. Now you need $12,570. I don't want to do $12,572 land. That's too much money. All right, well, let's buy some insurance then. We're going to come in here and we're going to buy a put this time. Okay, going to buy a put because if we sell a put, we're going to collect the premium of $280. But we needed $12,000. I don't want $12,000. I'm going to buy some insurance. The insurance is $142.50. I have to subtract $142 out of my $280. Gives me a profit of $142. That's a lot of insurance land. $142 worth of insurance. That means I have a margin requirement of $370, which is my max loss. My return on my risk is 38%. That's pretty darn good. Most guys will wait 3 years to get 38% on their money, but I'm going to get it in the next 4 hours. Yeah, that's called a pretty high risk. All right. Okay, well, let's look at the risk on this thing. Let's go over to the puts. You got a 64% chance that it's going to stay inside, that thing's going to be profitable. You got a 78% chance you're going to have to pay full loss. Margin requirement, or you got, that's actually, it's the other side of that. You got a 21% chance you're going to have to pay full loss. Well, we could reduce that. Let's bring that out. What's that one? Oh, now you only have a 14% chance you're going to have to pay full loss, but the full loss amount goes up. Margin requirement is $574. Bring it back in just a little bit closer. Now it's for $370, but it's still outside that RAF. That RAF is your tool right there that's telling you where the likelihood of where that market's going to be at the end of the day. Is it always right? Nope. It's not always right, but that's your probabilities. Well, maybe I don't want to take that big of a risk, Len. Okay, well, move your insurance out and move your premium collection out. Now you're going to receive, now you have a 14% chance that you're going to have to pay max loss, which is $398. You also have a 26% chance that you're going to have the market come down here into the red line, which means you're going to lose $182. All right. So there's a difference between the $182 and the $398. That's because you're going to lose $182. You're going to crash your car, and your car is worth $182. The insurance is going to pay $398 towards that. You're going to pay $87 for the insurance premium. Therefore, your max loss is $398 because you have to pay for your car and you have to pay for your insurance premium. But then you're not going to have to, well, let's say it's not you're going to total value of your car. That's the cost of the accident. Trying to relate this to your insurance. So to your car wrecking. All right. So if you wreck your car, you're going to have $182.50 in damages. And you're going to have to pay $87.50 in insurance so you don't have to total your car for $12,500. How's that sound? Is that a good analogy? I like it. All right. So that's the name of the game. And then the probabilities that somebody's going to hit you while you're driving drunk down the road is 85% here or 72% here on the probabilities out of the money. Probabilities in the money is 27.24 and 14.43. So your probabilities of losing money are down here, 14.44 and 27. And these are the probabilities you're going to make money. 85% of you got to actually 72% that you're going to make money, 72% chance that you're going to make money. And that RAF says that you got, it's going to be inside the RAF. That's how we use the RAF. And you're like, well, Lan, that's pretty cool. If it's going to stay in the RAF, why don't I put on both sides? Why don't I put on both sides? I could sell a call, sell a put here, put on my insurance policy. I could come up here and I could sell a call up here, sell a call, and I could buy a call up there for 57. Now I got one on both sides because, hey, if it's going to stay in the RAF, why not? Okay, you know what that's called? That's called an iron condor. That's an app. That's a strategy you can do. These are called vertical spreads up here, vertical spreads. And when you do one on the top and you do one on the bottom, you combine them together. That's called an iron condor. That's how you do iron condors. You get your RAF, you find out your probabilities, where you think that market's going to be by the time it hits that purple line, and you set your wings of your iron condor or your vertical call and put spreads outside of that probability statement. Now, you could come in and say, well, I want to be more conservative. Okay, we'll put them out farther. And you can put this one out farther. But Lan, what if it comes down and it goes past my red line? What do I do? Well, you have choices. And the reason I want to bring this to your attention is because I had that question the other day and I put it into your spreadsheet out here. So if you guys go out to your slides, I think I put it in here. Did I mention this to you last week that I put this in here? Because we had a question. Was it you, Bruce, that asked me, or who was it? Well, I think it was Bruce. No, wait, maybe it was it you, Bruce, or WNC Randy? Who asked me? Somebody asked me anyway. They asked me, what do you do if the market leaves? And I put that into your slides for you. So, it's not here. I haven't posted it yet. You guys want to give me a minute and I'll go post it for you? Tell you there's 5 things that you can do. Give me a second. I'll go do it for you. Give me a second. It won't take me long. This is the tool I use to create this stuff. Not that it's an advertisement, it just happened to pop up on this screen that's being projected. Oh, no, it's not. All right. You're not seeing my back end stuff. Hold on a second. Don't run off. Wait for me. Give me a second. I'm going to post something for you for free. Update that website for you. Should have done it earlier, but I didn't realize I hadn't done it. It only takes a second. because it gives you some rules, some things that you can do to mitigate your losses. All right, file, export PDF. We're going to put that in here. Hold on a second. Desktop, cheat sheets, live class, slides, export, replace, export. All right, here it comes. This will only take me a second. Watch your markets while I'm doing this. Go look at the Russell. See what the Russell's doing. Okay. Ooh. Hold on. I got it. It's right here. I just have to figure out how to get it up to you guys now. It's being stupid. Of course, everything's being stupid when you got people watching. All right. One back. Okay, here it is. All right, mitigating. What if I sell and the market rallies? Okay, or in this case, what if we're buying, the market falls? Okay, how do we mitigate a situation like this where the market might come down and go into our red line? What do we do? Or it might go up and go into our red line. Oops, I hit the wrong button. Move the chart. That kicked out all our orders. Doggone it. What if it goes up and hits our red line? We can put those on there real fast again. We're going to sell a call. I'm going to buy a call. I'm going to sell that out. One more click, 2 clicks. And we're going to do buy a put. Now we're going to sell a put first. Seller put and buyer put. Okay, there's our iron condor. So what if the market comes in and breaks out of our channel? What do we do? How do we mitigate that? That's what I just pulled up here. And I'm going to post this out there online for you. But it's right here. Here's our new thing. I wrote this thing for you because I think Bruce is the one who asked this question. So you come in here. You can see, you can do as you mentioned. Just wait and see if you will fall below your red line. Okay, so Bruce came in and he's like, what do I do? Do I just wait and see if it comes back? That's one thing you can do. You can just wait and see if in this case, we were talking about the long position, right? If it goes up into above the red line. So I guess I reword this. Just wait and see if it falls below your red line again. You would need to be confident in your technical analysis approach that the market would return. So that's your swag, your scientific wild ass guess. What if it goes up and goes above here? Well, you could just wait for it to turn and fall back down into your RAF. All right. If it falls back down into your RAF or back below the red line, that's really all it has to do. Just has to stay below the red line. If it stays below the red line, you make your money. That's all there is to it. So if it stays above the red line, if you're going to put one on both sides, it just has to stay inside this box right here. As long as it stays inside that box, you're going to collect your premium. What's your premium? Well, in this case, it's $195. All right, because we pulled it away from the market. So we're going to collect 205 here. We're going to collect 72 up there. We're going to pay $17.50 in insurance. On this one, we're going to pay $70 in insurance on that one. Now, we could go a little tighter if we wanted to. You could bring this down and make a little bit more money, but it's got to stay. It's going to shrink your box. It just has to stay inside that box now, which is still inside the RAF. You bring your insurance policy in and pay a little bit more insurance. Now you're going to receive $235. But we might have to mitigate. What if it goes up there and goes above the red line? Well, you could wait for it to come back down, or you can exit the trade. Just take your lumps and, again, as suggested, just get out. Okay, so you could just get out if it goes up above the red line, you can just get out, take your loss. You can do that. If it does it early, that's what you might want to do. Actually, if does it early, you can take it off because it's a smaller loss, and you can put it back on later. Or if it does it early, you could think about it this way: it's got more chance of coming back into the RAF. So, you're going to have to decide. What's the right answer, Land? There is no right answer. There's 5 right answers. You can do any of these. You can double down. You can dollar cost average into the position, put on another spread or 2 further out. All right. So then you can put on another one. You could say, well, if it goes up to this one, I could put on another one. You could come in here. Let's go ahead and put this on for fun. Let's go ahead. We're going to mark it into this. I'm going to place the order. Okay, we're in it with our iron condor. So you could come in and you could say, well, what if it goes up above? You could come in and you could put in another one. You could come in and you could say, okay, I'm going to sell a call up here. And of course, you would do this when it's up there. You don't want to do it right now. Obviously, wait till it gets up there, and then you buy a call. Appears your insurance. You put on another leg out there. All right. So you could do that. That's dollar cost averaging. That's building a pyramid with options. You can do that. All right. And then if the market turns and falls back in your favor, you'll make some money. This one should help pay for the losses of this one. So it might not be as great, but it will, take away the sting. You won't lose as much. Now, right now, it only shows $37. But if that market went above that red line, this one would suddenly be worth, $100. So take that into consideration as well. So that'd be worth more money. You're not going to do it now, but if it goes up there, you could add another one on. You could add another one on. So that would be building a pyramid with options. All right. So that's one thing you could do. The other thing is you could roll your position up and out, or just up if you're trading 0 DTE options. Rolling up means selling the position you have and putting it on at a higher level, possibly with a larger quantity. Rolling out means adding additional time to the option's expiration. You can roll up and out or just up. So up and out means that you would add time to it. So if we're in a 0 DTE, you could add another day to it, put it up there. It's going to be a lot more money. The market would have to go up there, and now you got another day, but you would liquidate this one and roll up to the next one. So that's what you do. That's generally what I do. I'll generally roll. All right. So I'll do is, rather than dollar cost averaging, leaving this one on, I'll roll this one out and add on. So this is what I would do. I come in here and I would say, I would break these apart. I generally, when I put on an iron condor, I don't connect them all. It's nice to see in here. You can see all four of them on here. You can see we're up $37, all four of them together. But usually when I put on an iron condor, what I do, hold on, I'm losing my mojo here. Trying to figure out this YouTuber stuff. So then I can see them separated, because I like to see them in separate positions, because then I can control one or the other. Okay, I can roll just this half. I don't want to roll the whole thing. So I'm going to roll. You can retrade single options. You can roll your options, but I can't roll up using the auto roll, because I can't roll an iron condor up. I can only roll a half of it. So I want to break those apart. Technically speaking, I can come in and break them apart here. I can come in here, manually link. I could remove two, remove the legs. I'm not even sure if those are the right legs. Let's just remove all the legs. So we're going to unhook them all. Is it going to let me do that? No, it's not going to let me do that. Anyway, when you put them on, I like to put them on separately so I can roll them out. Because then when you roll them, all you do is you liquidate this one and you add two more on further out, and you can add time if you want, and you do it all on the same ticket. So it just kind of moves it up, is what it does. You take a little bit of a loss in doing it, but then you get more. And then I'll add a second quantity. So if I'm quantity one here, the reason I always start with quantity one, I trade small, right? Trade a lot, but trade small positions, so that you can then roll up, and then you can add on to a second one, add on to a third one if you need to, and it's not going to kill you. So that's how I do it. I roll them out. That's just one of your solutions. The other option is you can add the other side to the trade. If you sold a vertical call spread, sell a vertical put spread, turning it into an iron condor. And that's what we did here. So if the market goes up and breaks this one, well, sell the other side rather than roll it out. But you can do both. You can sell the other side, put on the other side, and also roll it. So I'll do that sometimes too. So that's how you mitigate if it goes outside the RAF. I know. We can do it, though. We'll do it. We can do it together. We'll just keep doing these things. You guys just keep coming, and we'll just keep doing this stuff. And you get exposed to it, and the more you get exposed to it, the more it'll make sense. And you can just practice it on your own and say, oh, this is what you do. You roll them out. The way you do it is you roll them out. You just sell this one and buy one further out and add more quantity to it. That's how you do it. All right. So those are basically your 5 steps to mitigating. And we'll go through them again. Don't worry. I mean, this might seem a little, and I'll rewrite this a little bit before I post it out for you guys to download, but it'll be out there on the internet. What's the link again, Lan? It's out there on pitnews.com/ what do we call it? We just called it slides, didn't we? Slides.pdf. I think we just called it slides. So it's pitnews.com slides PDF. Let's go try. We'll go try it and see if the old one's still out there. pitnews.com/slides. Yeah, slides.pdf. That's it. So this is the old one. I will update this and I will put this new information in there. Okay, so this is the old slide deck. And I will go put that new one in there for you. So you have this information. And I'll try and expand on it a little bit for you, but we'll do it over and over. We got an iron condor on here now. I don't have to roll yet, so we'll just leave it, see how it does. And we were going to do, but that's the RAF indicator, and that was the most important thing. That's what I wanted to teach you today, is about the RAF, and I apologize for having that moment of where I was doing all that stuff with the RAF and you guys couldn't see it. I do that sometimes. So, all right. So that's how we turned out today so far. Let's go look at our spreadsheet, should we? We haven't looked at our spreadsheet in a little while. I was going to use today was going to be Monday was going to be our seasonals. We're going to go do seasonal. We're going to have to do that tomorrow because I wanted to show you the RAF and I wanted to put these options on and I wanted to show you how to do this. So we're going to have to do our season. We're going to have to do our seasonals tomorrow. So let's go to the spreadsheet. So how did we do today? So far we did $121. Oh, look at this. This is how our put options went yesterday, last week. When was that? That was Thursday. What happened Friday? I'm missing a day. This is the put option we purchased at the morning S&P rally in anticipation of the counter trend fall. It worked out nicely. That thing dropped like a rock. Remember that we bought a put option when we were remember we were talking and we said we should figure out a way to trade these markets on these opening bells because we know that what they do is they go up and then they turn around and flush really hard, right? Or they'll go down and then they'll climb really fast. And they do that in that morning bell. So I said, well, why don't we, when this market rallies really hard and starts to look like it's dying, we'll buy a put option. And I did. And then, of course, class got over and I just left that put option on there and let it ride. And that market, and when I came in and started to dampen down at the bottom, we were up $1,500 on that put option we bought. So I liquidated it, took it off, $1,593 on that put option. And so there you go, Michael Bruce. I got those in a separate column for you so you can see our put option stuff. I didn't trade after that other than just to take the put option off that we put on. This was the 37.50. Tried taking a short position out of the opening bell on Russell twice. Both of them failed. Put on a put option on the S&P, which paid off $1593.75. This does not go here. This is not the 23rd. We're at the 26th. I'm going to have to go back and look at our videos. What did we do on Friday? Or was this Friday and I missed Thursday? Anyway, I missed a day last week. I don't know what we did. Well, that kind of sucks. I don't know. So look at that. Our goal for the day was 121.24. The max loss we wanted to quit at was 242.40, but our profit goal was 121. We missed it by 24 cents. Are you going to go back and place another order and try and get back your 24 cents? No. You wait till 10 o'clock and see if a trend doesn't come in at 10 o'clock. You can go trade again. All right. And plus we got our option on there. So we'll see what happens with our options. We'll see if we can't make that work out for us too. All right. Does anybody have any questions before I let you go for the day? I like to come back and look at our comments. If you guys enjoyed today's lesson, I know it got a little bit crazy in there and we got a little bit advanced on some of these RAF things and some of the probabilities and some of the options doing these advanced option strategies. I know we got a little advanced, but just keep sticking with us and come back. We'll figure this all out. We'll figure all this stuff out. You know what? I think I figured out what's wrong with our calendar. this was a holiday. Oh, it's got a holiday up there. And then I show a winner, 2 losers, and then a winner. I'm missing a day in there somewhere. I don't know. I'll have to go back, look at our videos and see where we were at. All right, guys. If you want to do that YouTube stuff, give me the thumbs up, do the like and subscribe. Come back tomorrow. We'll do it all again. All right. If you like this, give me a thumbs up. Let's have a thumbs up. If you have any questions, leave them in the comments and I'll answer your questions over in the comments. Bruce is a good one. He likes to go and ask questions about the class in the comment section. The rest of you, would be nice if you'd go do that too. If you have your question, put them in the comment section. I can answer them over there. And we will see you guys again tomorrow morning. Same bat channel, same bat time.